today we are learning about technical analysis, right? And so technical analysis is basically a way of analyzing the stock market. So it's part of finance, and we use data and numbers and then candlestick and the trading stock charts to analyze the market and to make money. So what are indicators for? And they're shown everywhere in the media, in the news. But then you can see these lines, right? These huge bands around it. That is one of many indicators. So that's what indicators will look like. So technical analysis includes not only candlestick patterns and chart formations, but also something what we call indicators. And indicators are tools that analyze the price using certain formula, right? And it supports our decision-making with direct visual evaluations of our chart. And indicators usually analyze the characteristics of candlesticks. So it builds onto the knowledge of candlesticks and the size, the opening, the closing, the wicks of these candlesticks, and considering the ratio between the buyers and sellers. Now, let's look at the stock market in a very simple point of view. So what is the stock market? Let's treat it as a battlefield between the buyers and sellers. So we have people buying stocks and people selling stocks, right? And in the stock market, it's basically a battle. So when the stock market is going up, the buyers are winning. When it's going down, these sellers are winning. So let's look at it as a battle in the most simple term. Okay, so indicators, there are numerous amount of indicators, and we usually divide them into three groups. So momentum, trend, and volatility. So the third one, chart studies, is what we've been studying in the past 10, 11 classes. So these are basic understanding in understanding the indicators. But so I will each of these categories, I'll tell you guys what each categories are, and we will be teaching one indicator from each category. So momentum indicators. So we're starting with the first one, right? Momentum indicators, they're often known as oscillators. And because they oscillate between the defined upper and lower limits, they help us analyze the ratio between the buyers and sellers to understand which group, like which team is winning the battle between buyers and sellers. So today, within the momentum, so basically in simple terms, you're assessing which team is stronger. And today we're going to take a deep look at the relative strength index, so the RSI. So this is what we'll be learning under momentum. And trend indicators from the name. So trend, what is trend? When we look at TikTok, right? I'm sure a lot of you guys watch TikTok. So what are TikTok trends? There are videos that a lot of people watch, right? So with trends in the stock market is if a lot of people are buying, the buyers are winning. There is a buying trend. That means there's an upward trend, right? With the stock market is going up. But then if a lot of people are selling, there's a selling trend. So the stock market is going to go down. So there's a downward trend. So trend indicators analyze the trend, and they're generally, they're not like as effective when price enter a sideways phase. For example, neither of the buyers and sellers are winning. There's no trend. So in this case, the trend indicators wouldn't be useful. And today we're going to be talking about moving averages. So this is the most popular ones that traders use in the media, in Wall Street, and we'll be learning about what this is today. Okay, for the third category, the volatility. So volatility indicators, this is the group of indicators that checks the degree of volatility, which means like the fluctuation. For example, the stock market is going up, down, up, down, up, down, up, down, up, down. So this is what we call highly volatile, right? It's fluctuating a lot. So in a volatility indicator, it would be like, okay, so it would indicate it's volatile. But if the stock market is going like this, right? It's going up like this, it's very stable, and then it's going down. So this second one that I drew compared to the previous one is a lot less volatile, right? It doesn't fluctuate as much. So then the information that volatility indicators will give us is usually needed when placing trades, when we're setting stops, and when we're setting like entry points. For example, we want to enter here and then make money right here and sell here, and enter again, make money here, and then sell again. So volatility indicators will help us to find these points exactly, okay? So, oh yeah, with the volatility indicator, we'll be learning about the Bollinger Bands today. So this one is very interesting. So let's start with the RSI, Relative Strength Index. So this is a momentum indicator. So the relative strength index is one of the most popular indicators among the traders within the momentum section because it is versatile and it provides very good signals when used in the right situations. And the relative strength index is a momentum indicator, which means it indicates the direction and the strength of the movement, okay? So let's talk about this image and exactly how this indicator works. So the default setting, what we call setting, right? I'll show you guys exactly how it works. So the setting of the relative strength is 14 periods. Now, each period represents one candlestick. So 14 periods, which means 14 candlesticks. And if you were to count, this section is exactly 14 candlesticks. Now, this indicator compares the average profit and average loss. So it analyzes how these 14 candlesticks have risen and how have they fallen compared to their sizes. So the value of the relative strength index ranges between 0 and 100, which makes it an oscillator. For example, all of the past 14 candlesticks have been raising, right? They have been green. The index will be 100. But if all 14 of these has been red, it has been going down, then the value will be 0. So if we consider a scenario in which half is green, half is red, so half is going up, half is going down, and they're relatively the same price, the index will then show a value of 50. So right in the middle of 0 and 100. So if like within the 14, the more candlesticks have fallen, the larger their size. The larger the relative strength value, and same vice versa. So let's carry out the detail in the chart because it's very superficial when we just explain. So in this image, right, it shows an upward trend. This is upward trend, right? Trend is going up. So the trend of going up, upward trend of over 14 candlesticks. And all these candlesticks, except for 2, so the darker ones, right here, except for 2 are rising candlesticks. So they're green, they're going up. They are opening a price with a higher closing price. So in addition, the rising candlesticks they're relatively large, right? They have very large bodies and small wicks. So wicks are these little gray things that sticks out on the top and bottom. So in this, the RSI value would be 75. So it's pretty high and it's confirming an upward trend with a lot of momentum. Momentum means drive, right? Because this is a type of momentum indicator. So this is our stock trading chart, right? And okay. So, and we go to indicators and we find relative strength index. So right here. So we click and you can see, whoa, there we go. Here it appears. So when I was teaching the last class, I changed the setting a little bit. Oh, I didn't. So right now, 14. So this is the default setting, right? And let's make this a little larger. So this will be the relative strength index. Now this looks very, very complex, right? Let's break this down. So as you can see, the chart is divided in half. You see a line right here, right? You guys see the horizontal line? Okay, so this line, so right here, you see the numbers here. This is the current value of the stock price. So let's say $424, 428, 432. And right here is the value of our relative strength index. So we have all the way from 0 to 100. So as we talked about before, the higher the value, the stronger the trend, the upward trend. The lower the value, the stronger the downward trend. So let me give you guys an example. Let's go to 1 hour period. So this is period, right? How much time each candlestick represents. For example, right now I'm 15 minutes. Each candlestick on my chart represents 15 minutes. And when we call it 14 periods, like the default setting, that represents 14 candlesticks. So if that connects, let's go to 1 hour. And let's get rid of the indicator. Okay, so let's count. Let's take these 14. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Exactly right here. So we are taking this 14 candlesticks. So it is really hard to estimate, right? Because we need to measure the exact length and average it out. So that's why we use indicators, because they automatically consume the data and give us the value that we might need when trading. So in a real-time trading, the indicator of a relative strength index will look like this. Okay, and so this indicates the value of the 14 candlesticks. Now you might ask, okay, why are we doing 14? Why not we do 50 or 1? Because we want to see the average of that. And with 14, it is most common used, and mainstream social media use those, but we will dive into the specific period that you want to select later. So I'll introduce that. Okay, so that's relative strength index. So that is the momentum indicator. So now let's talk about moving average. Now this one's very interesting because almost everyone uses it. So moving average also, moving average, shorter version, what we call MA. So M stands for moving, A stands for average. MA is by far the most popular indicators used by numerous traders and even in mainstream financial media. For example, the Wall Street Journals, the CNN, when they report on the financial market, moving average is usually in there. And when if you look at the news or you start looking at the news, you start paying attention to that and you will be seeing moving averages. So what is the function of moving averages? Moving averages indicates the average price. So the previous one gives you the momentum, it gives you a digit, right? So this one gives you the average price. And same as before, there's the settings for the period. So how many candlesticks are we taking in consideration with our moving average? So usually the default setting is also 14 candlesticks. And why is the moving average so important? Because it can give us a big picture on if the current price is trading above or below average. So if it's above these average lines, it's above average. If it's below, it's below average. It's same as like if you're in a math class, right? And you have a class of 30 students and you take a math test and you compare all the scores and you look if you're above average or below class average. So it gives you an estimation of where you are in the class. So this thing gives you an estimation of, okay, are we trading above or below average, which can indicate important trade signals. So if we're above average and we hit average, you can expect it could go below average a little bit. So you can see that these two cross and then goes up, down, like that. So moving average, you can see here. So there's moving average, exponential, moving average, simple, moving average, weighted. And there are, I think, 5 other types, but the most used are moving average, exponential, and simple. So I just put the 2 lines in here. So what's the difference between them and how do we choose them? So the exponential and the simple different due to their calculation. So how they're calculated. The simple one is very simple. So it's calculated with the average. So we take the 14 candlesticks, we add them together, we divide it by 13, and we take the percentage and we get the value, right? It's how you calculate any other average. But with the exponential moving average, it takes in consideration of the last candlestick, more weighted than those. So if you're in a class of 50 students and we're averaging the test scores, for exponential, instead of simply measuring each student worth 2%, right? 50 students, each worth 2% out of 100, we are taking the 50th student, let it be them weighting 10%, and the rest 90% being split by the 49 rest, the rest of 49 students. So this means that exponential moving average will be changing more quickly than the simple moving average. Right. So number 2 is the EMA. So why? because it reacts more with the price. So let's analyze exactly how it reacted more. So let's look at here. Let's look at this section. So as you can see, the stock, it went up, down, up. And the red line, which is the exponential, it reacted more when the stock market went up compared to the blue line. Can you guys see this? So the curve right here, it shows that it fluctuates more than the blue line because it reacts with the last candlestick that forms. So that's kind of the difference between the two and how you can identify it. Well, so let me introduce you guys the different type of traders. So we have day traders, swing traders, and investors. Day traders or day trading is when we buy and sell stock within the same day. So I buy it right now, I sell it in the next few hours. But swing trading is when I hold the stock. So I buy it today, I hold it within the next 3 days, the next week, or the week after. And then investing is usually when we go to a year, right? I invest into Apple right now and I sell when I'm 23. So I hold it for 5 years or 10 years. So that's investing. So that's a basic difference between different type of trading. Now, depending on your trading style, like swing trading or day trading, you will be choosing which indicator to use. So for simple moving average, that gives you an average of the long term, right? Of all these, you're considering all of them. That would be for investing in swing trading. But for day trading, because you're entering and exiting relative to the dynamics of the price fluctuations, you use the exponential one because the average give you a more accurate description of the current price right now because it fluctuates with the price. I want to go over briefly on the different type of periods. So periods meaning our settings, right, for our indicators. So we set 14, that's the standard, or we set 9, 10, 12, 20, 50, 100, and why we do those. Let's start by the smallest units. So the smallest unit people would use with indicators is 9 or 10 periods, so 9 or 10 candlesticks. So these settings are popular because the moving averages, they react very quickly to the changes. This number of period is particularly suitable for day trading. Okay, so that's for day trading. And what about 20 to 21 periods? So I'll switch it. So you'll see the difference between them. So we put 20. You can see, oh, it's a lot more average. Okay, so now it is an average, right? It doesn't move, so the price goes up and down. The average, it's just giving it to you because we're considering 20 candlesticks. This is a range of a medium term moving average that can be used in smaller as well as higher time frames. So smaller time frames and higher time frames. And this is a universal tool. So 21 is the standard for media reports. And they usually would put 21 in their news report and their analytics. The 50 is actually very popular. It is often used to draw the support and resistance. So last time we learned about drawing support and resistance, right? They're basically these lines that we draw for trends, right? So this will be a support, and then this will be a support resistance line. So when we have the 50 period on, it usually helps us to draw the support and resistance. And that's a really popular tool. And so now if we were to move on to 100, and now it's even more flat, right? Because we're considering more people in the data. So this is regularly used by swing traders in very high time frames. And like on television and financial data, you also see this sometimes, but usually this is used by swing traders, right? We're trying to hold the stock for a long time. I just want to get an average of what it looks like. I don't need to know these little fluctuations in between because that is not part of my trading. I want to see it, how it's going to work in 3 weeks or 5 months. So that's usually how you would decide on what kind of time frame you'll choose. So the Bollinger Bands. This is, I say, the most complex indicator out of the 3 that we're talking about today. And so you can see, right, there's 3 lines, 1, 2, 3. Each one indicate a different thing. What are Bollinger Bands? Bollinger Bands, they are versatile, and we can use these indicators in numerous situations. For Bollinger Bands, they're very dynamic. They consistently adapt to the changing market condition, which can be a big advantage. But this is one of the most complex indicators to understand and really to master when using. In this image, it shows a Bollinger Band, right? It consists of a channel which encloses the price on both sides. And we have the middle band. So the channel is the upper and lower, and the middle band. So the middle band is the moving average, which we learned previously. So this is basically the moving average. So moving average is a part of the Bollinger Band. So the outer band or the upper band right here measures the volatility, the extent which the price fluctuates. Again, momentum, right? So the upper one is kind of the momentum. And then we have the, for example, when the price go up, it's more and down more strongly, and then they contract, etc. So that's the outer band. Band 1 and 2. When the volatility increases, the band widens, so it creates bigger bubbles. For example, right here, right? It's not very volatile. It's going up, down, but then you see a very obviously downward trend. So right here is comparatively, the band is narrower than this. But then you see these two huge bubbles. Why? Because of fluctuation, right? All of a sudden, it's a huge candlestick. Oh, Lord. And then all of a sudden, you see another jump. And then so the Bollinger Bands, it indicates that it's very volatile with these huge bands. And then the middle, we already said, it's the moving average. So here is where it gets really complicated. So the default setting for Bollinger Bands, it's usually 2.0 standard deviation. Now, if you haven't studied statistics or pre-calc, you probably don't know what standard deviations are, and that really complicates of how to use this. But standard deviation, it's a way of measuring range. And range is the distance between the most upper price and the lower price. That is Bollinger Bands.